The silver price just fell 35% from its January record. The physical deficit behind that price just got wider, not smaller. Two facts, moving in opposite directions, both true at the same time. Most investors watching the chart assume the falling price means the crisis is easing. The smarter question is not what the price is telling you, it is what the price is refusing to tell you. By the end of this analysis, you will understand why those two facts can coexist, and why that gap is exactly where most portfolios are about to be wrong. Today is Monday, July 13th, 2026. Silver spot is trading at $58.72 an ounce, down $1.15 on the day. Gold sits at $4,063.91, down $57.28 after a weekend of fresh United States airstrikes against Iran. The gold to silver ratio has widened to roughly 69, meaning silver's industrial exposure is amplifying every macro shock more than gold's. Washington carried out its fourth strike on Iran in a week over the weekend, and Tehran responded by declaring the Strait of Hormuz closed until further notice, a claim U.S. Central Command has publicly dismissed. Markets are also bracing for a fresh United States inflation print later this week, the data point the Federal Reserve will weigh most heavily in its next rate decision. That is the surface. Now we go underneath it. To understand why silver's deficit keeps widening while its price falls, you have to understand something most viewers never think about, which is how silver actually gets mined. Unlike gold, roughly 2/3 of the world's silver does not come from mines built to produce silver. It comes out of the ground as a byproduct of copper, zinc, and lead operations, where silver is a secondary metal riding along with the primary one being extracted. This only makes sense once you understand the incentive structure underneath it. A copper mine expands or contracts based on the copper price, not the silver price. So even when silver rallies 42% in a single year, as it did in 2025 according to the World Silver Survey, 2026 from the Silver Institute and Metals Focus, the mines that produce most of the world's silver have almost no reason to increase output. Before we get to the consequence, we need to understand that cause fully because it is the entire mechanism. Global mine production is forecast at 844.1 million ounces for 2026, essentially flat, despite that record price move the year before. Think of the silver market like a reservoir with a fixed inflow pipe and a demand tap that keeps opening wider. Solar panel manufacturing, electronics, and now accelerating electric vehicle production keep pulling harder on that tap. And the pipe simply cannot widen quickly because bringing a new primary silver mine online takes 5 to 10 years of permitting, capital, and construction. So what fills the gap between supply and demand? The reservoir itself, the above-ground stockpiles built up over decades in exchange vaults and institutional storage. Since 2021, the Silver Institute confirms this reservoir has been drawn down by a cumulative 762.1 million ounces, covering 6 consecutive years of deficit, with 2026 forecast to widen that gap to 46.3 million ounces. That is the mechanism. Falling reservoir levels, not mine output, are what silver's actual physical story has been about. Here is what most of the coverage on this story is missing entirely. Nearly everyone reporting on silver right now is treating the price decline as the headline, when the more important number is what has happened to unencumbered inventory sitting in London vaults. According to Silver Institute data, the freely available, unencumbered portion of London vault holdings fell to just 17% in September of last year, a historic low. That is not a talking point. That is a structural liquidity signal, the kind Bank of America and JP Morgan commodity desks track internally long before it becomes a retail narrative. What most commentary gets wrong is treating the current pullback as evidence the deficit thesis has failed, when in reality the pullback is being driven by something else entirely, a macro deleveraging tied to Iran-related inflation fears and a hawkish Federal Reserve repricing, which is a completely separate force from the physical tightness underneath it. Those two forces can point in opposite directions for a while. That is exactly what is happening right now. If this kind of distinction, price mechanics separated from physical mechanics, is the level of analysis you have been looking for, this is the moment to subscribe. I publish this breakdown weekly, tracking the exact data points, COMEX warehouse levels, Silver Institute updates, and Federal Reserve signals that actually move this market before the headlines catch up. You are not subscribing to a channel, you are staying ahead of a story most people are still reading a week late. Now come back to the analysis, because the harder question is still ahead of you. There are two versions of every investor holding silver right now. One version understands exactly why they own it, can explain the mine supply mechanism in one sentence, and has a defined price and time condition under which they would admit the thesis is wrong. The other version bought because the number was going up, watched it fall 35% from the January high, and is now quietly hoping it simply returns to where it was, without being able to say what would actually have to happen in the physical market for that to occur. The uncomfortable exercise is not deciding which version sounds better. It is being honest about which one actually describes your last 6 months of decisions. That is not a judgment, it is simply a mirror, and only you know what it shows. From here, the market splits into 3 plausible paths, and the data between now and specific dates will tell us which one we are on. Scenario 1 is the macro deleveraging path, where Wednesday's United States inflation print comes in hot, the CME FedWatch tool reprices toward a more hawkish Federal Reserve path, and silver grinds down toward the $50 to $55 range, even as the physical deficit keeps widening underneath it. Scenario 2 is the geopolitical escalation path, where any confirmed disruption to shipping through the Strait of Hormuz, verified rather than merely claimed, sends oil sharply higher, revives the stagflation trade, and pulls silver back up toward the $65 to $70 range alongside gold. Scenario 3 is the physical breaking point path, where COMEX warehouse data and London Vault unencumbered levels keep falling toward that critical mid-teens percentage. Delivery notices tighten, and silver spikes toward $80 to $90, regardless of what the Federal Reserve does, purely because the reservoir runs too low to keep rationing by paper price alone. I'm not going to tell you which of these is more likely, because the honest answer is that nobody, not Goldman Sachs, not Wells Fargo Investment Institute, not the Silver Institute itself, knows yet. What we will know by the next Silver Institute data update and the next several Federal Reserve meetings is which of these 3 forces is actually winning. So here is the question I want you to sit with, and it is not about price. When you own an asset whose scarcity is real but whose price can still fall for reasons that have nothing to do with that scarcity, what does that tell you about the relationship between truth and price in any market you have ever invested in? Leave your answer in the comments. I read every one of them, and the conversation those answers generate is often more valuable than the video itself. This is for education and discussion only, not personal financial advice. I am sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk.